Spending in the economy takes many forms. At any moment, the Smith family may be having lunch at Burger King. Ford may be building a car factory, the Navy may be procuring a submarine, and the British Airways may be buying an airplane from Boeing. GDP includes all of these spendings, okay? And to understand how the economy is using its scarce resources, economists study the composition of GDP among various types of spending. To do this, which we denote the GDP as Y, as you see this equation, GDPY is divided into four components. Consumption is labeled as C, investment labeled by I, government purchases G, net export NX. As you see, this equation on the bottom line, here I will show you, is an identity, okay? An equation that must be true because of how the variables in the equation are defined. In this case, because each dollar of expenditure included in GDP is placed into one of these four components, either this one, this one, this one, or this one, the total of the four components must be equal to GDP, which is here Y, GDP, okay? Let's look at each of these four components more closely, starting with consumption is the spending by households on goods and services, with the exception of housing. Okay, purchases of new housing is not a consumption. Okay, as not consumption, we consider as investment. Goods include, for consumption goods may include durable goods such as automobiles and appliances, and non-durable goods such as food and clothing. Services include such intangible items as haircuts and medical care, and household spending on education is also included in consumption of services. Okay. Only exception is housing. Note that on housing costs for renters, consumption includes rent payments. For homeowners, consumption includes the imputed rental value of the house, not the value of the house itself. Imputed rental value. So the rent payment is consumption. Or if you are a homeowner, imputed rental value of the house is a consumption, but not the purchase of price or mortgage payments. Next is investment. Investment is the total spending on goods that will be used in the future to produce more goods. What kind of things is considered as investment? Includes spending on capital equipment, machines, tools. If you buy a coffee machine to produce coffee, it's an investment. Structures, factories, office buildings, and houses. If you just graduate as an accountant and get an office building, then it's considered as an investment. Inventories, goods produced but not yet sold. So let me clarify this part. Let me give an example for inventories. When Apple produces a computer and adds it to its inventory instead of selling it, Apple is assumed to have purchased the computer for itself. Okay, you produce Apple phones, but instead of selling it, you put it in inventory, so it's going to be considered as investment spending. And these national income accountants treat the computer or the Apple iPhone as part of Apple's investment spending. If Apple later sells the computer out of inventory, Apple's inventory investment will then be negative, offsetting the opposite positive expenditure of the buyers. So when Apple sells this computer, investment is going to go down, but at the same time, since it's a consumption is going to increase. And one important thing here is notice that GDP accounting uses the word investment differently from how you might hear the term in everyday conversation. When you hear the word investment, you might think of financial investments such as stocks, bonds, and mutual funds that we study these topics later on. By contrast, because GDP measures expenditure on goods and services, here the word investment means purchases of goods such as capital equipment, structures, and inventories used to produce other goods and services in the future. Next component is government purchases. Government purchases is all spending on the goods and services purchased by government at the federal, state, and local levels. It includes the salaries of government workers as well as expenditures on public works. Okay, the meaning of government purchases requires a bit of clarification. When the government pays the salary of an army general or a school teacher, that salary is part of government purchases. But when the government pays a social security benefit to a person who is elderly or an unemployment insurance benefit to a worker who was recently laid off, the story is very different. These are called as transfer payments, okay? Because they are not made in exchange for a currently produced good or service. Transfer payments alter household income, but they do not reflect the economy's productivity. So they are excluded from the GDP calculations, okay? Except transfer payments, any spending on goods and services or paying a salary to a school teacher because it's an exchange for a service is considered as government purchases, but transfer payments are not payments that the government is paying you for your service, so they are not included in GDP. Net exports equal to foreign purchases of domestically produced goods, exports, okay, minus the domestic purchases of foreign goods, imports, okay. A domestic firm's sale to a buyer in another country, such as Boeing's sale of an airplane to British Airways, increases exports. And a French buying, if you buy from specs, it increases imports, okay. And the net in net export refers to the fact that imports are subtracted from export. This subtraction is made because other components of GDP include imports of goods and services. So this is my GDP. To make this clear, I'm going to make an example. Let's say you buy a car, $40,000 from Volvo, the Swedish car maker. Since it's a consumption, buying a car, consumption will increase by 40,000. But I know that any good that are produced outside of the country, United States, is not going to be considered included in GDP calculation. So in order to neutralize the effect of this $40,000, I know that here there is one more component, export minus imports. I'm going to subtract this 40,000 from here too, because I know that this is an import, and import is part of the GDP calculation and it has a minus sign. Okay, since this calculation increases the imports as the same amount as the consumption, so what you do is add plus 40,000 because of consumption and minus 40,000 from import. That means GDP is not going to be affected, not affected. So that's why the GDP definition is very important, because this definition helps us to understand how we measure the GDP of a country. And here you will see the US GDP and its components by 2013. And in this year, the GDP of the United States was around 17 trillion. And dividing this number by the US population, you will get around $53,000 per person income. And consumption, as you see here, almost around 70% of total GDP, and the remaining is investment 16, government purchases around 19, and the net export is around 3% of the GDP. And here you see that net export part is a negative number. That means US consumers are buying foreign goods more than foreigners are buying domestic goods. And you can find more updated data from Bureau of Economic Analysis, the part of US Department of Commerce that produces the national income accounts. Let's do an example to understand GDP and its components. Okay. Let me try to make this screen smaller. Okay, here will be good. And now, here, the first part of the question, let's first read the question. In each of the following cases, determine how much GDP and each its component is affected. A. Debbie spends $300 to buy her husband a dinner at the finest restaurant in Boston. First, let's think about how can I categorize this purchase of $300? And I know from my accounting is that GDP is equal to consumption spending plus investment spending plus government purchases plus net exports. Okay. And then here I know that this is a consumption. Buying a dinner is a consumption. So consumption is going to increase by $300. So I can conclude that this all GDP, since one of the component increases by $300 on the right hand side, the left hand side, which is the GDP, should increase. GDP increases by $300, which is Y. Okay? So this was A. Let's look at B. Sarah spends $1,200 on a new laptop to use in her publishing business. The laptop was built in China. So again, let's write our identity. Y is equal to consumption plus investment plus government purchases plus. Instead of net exports, I'm going to write export minus imports. This is net exports. And what it says, okay, Sarah spends $1,200 on a new computer, so this part should increase by $1,200. It's a consumption. Oh, I'm sorry, it's for publishing business. It's not a consumption. If you buy goods and services to produce more goods and services, it's an investment. So investment is going to increase by $1,200. And at the same time, since the laptop was built in China, that means imports are going to increase by $1,200, right? So imports are going to increase by $1,200. Investment increase. Investment is a positive, but imports has a negative sign in front of it. So as you see, they will cancel each other, and Y, GDP, doesn't change. Okay? So this is how you think about how to incorporate any spending on GDP calculation. Let's look at the C part. I'm going to erase the first part. Okay. C. Jane spends $800 on a computer to use in her editing business. She got last year's model on sale for a great price from a local manufacturer. So remember again GDP definition. GDP includes the goods and services produced in a given period of time. So it's not including any used goods and services, which service cannot be used, but for the goods, the GDP is not including used cars or anything used computers. So this 800 is not going to affect the GDP. GDP not affected. We don't need to even look at the identity. And how about D? Let me erase B part. General Motors builds a 500 million worth of cars, but consumers only buy 470 million worth of them. Okay, how we are going to make this arrangement on this GDP equation? GDP is equal to consumption plus investment plus government purchases plus net exports. So General Motor builds 500 million worth of cars. Consumers buy 470 million of it. So the consumption will increase 470 million. How about the remaining 30 million? If a company cannot sell the car, it's going to take that car to the inventory. And we know that if a company takes any product to the inventory, it is considered as investment spending. So 30 million investment spending will increase. As you see, a total amount of 500 million GDP will increase. Okay, so the cars are produced and it's $500 worth. Only 470 million worth of cars are bought by consumers, so it's a consumption. Consumption will increase, and the remaining cars are still, there is a value to them. Since the company put them in the inventory, the investment spending is going to increase by $30 million. So the total GDP will increase by $500 million.